Okay, good morning, everyone. Happy Friday. Let's go ahead and get started here. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to give you another market outlook as far as what we're expecting going forward with respect to the market, options trading, and some of the observations and themes that we currently see in the markets. So let's go ahead and get started. Now, before I do that, I just want to do a quick sound check. Can everyone hear me and see my screen? If you can please hear me, if you can hear me, please type yes into the chat window. Okay, perfect. Great, so let's go ahead and get started here. The market outlook here is not too different from last week. And before I get started, just a quick disclaimer. What we're going to discuss here is purely for educational purposes and not a solicitation or recommendation to buy or sell any specific securities. So as I was saying before, the current market outlook is actually not too different from what we spoke about on Thursday and from a technical perspective. So if we look at the charts, on Tuesday, I was showing everyone the sell-off that we had during the coronavirus, the subsequent bounce. I had noted on Tuesday that we were pushing up against that 20-day moving average. And on the hourly chart, we were seeing that as markets were going higher, momentum was not confirming that and was actually moving a little lower. That negative divergence combined with the 20-day moving average, I was expecting that we would get some check back here, and we actually did a little bit, not too much. I think given the current market environment, a 3-4% pullback is quite normal in this particular market, and I think it's healthy after a 20% rally in the markets after a single week for it to check back a few percentage points if it was to have the steam to continue moving higher. Now, at this point, the markets are, I would say, pretty much in a bit of an equilibrium state. We're testing that 20-day moving average again on that daily chart. We're just a couple of points below that 20-day moving average on the hourly chart. Also, there's a little bit more divergence here, much smaller now. So markets are, at this point, again, in a bit of an equilibrium state. So a few things that's kind of, on the positive side. Oil, the news that we've seen over the last couple of days have lifted oil quite a bit. Brent run almost 21%, crude up about 12% earlier today. So I think that's providing a little bit of support in the markets. Some of the selling here that we initially saw obviously was due to the coronavirus, obviously due to lack of liquidity, but oil was actually a big factor in this sell-off. So oil recovering, I think, provides a bit more of a support for this current market. Now, the other good news here is that the VIX has pulled back substantially. So if you look at the VIX here, it's trading at about 49 right now. The 3-month VIX is trading at 47. So the backwardation that we've seen since February 21st. This is one of the longest periods of VIX backwardation, which means that the front month futures, or the front month VIX, which is the 1-month VIX, trades at a higher level than the 3-month VIX. And that usually tells us that there's distress in the markets, and that distress is almost normalizing. It almost normalized at the very bottom here, I believe on March 21st or 23rd or so, but then pulled back into what we would consider risk-off territory. And looks like we're just about, perhaps today, maybe going back into more of a risk-on environment. If we do, then we can certainly say that perhaps this market has formed a bit of a bottoming formation and is ready to retest that 262, 273 level here. So there are green shoots, I will say, in terms of that provides some kind of support of this being a market bottom, which again, I think is the question that many people are looking to answer. So I want to show you some of the research that we're looking at. First, let's just take a look at the coronavirus trends. So again, we've had almost a week of declines in terms of number of new deaths in Italy. Italy, again, is a good template right now that we're utilizing for developed countries that have instituted fairly large lockdown measures for their particular country. Right now, almost half of the world's citizens are in some way, shape, or form in a lockdown. So that is positive. The data that I want to show you is the fact that right now, and this is something that changes almost on a daily basis, is trying to figure out just roughly how long is the tail of a of this, so that we can measure roughly the economic impact of when we lock an economy down to when we can reopen their borders. China did it in 60 days. I don't necessarily expect most developed countries to be able to do it that quickly. But however, the reason that I want to point you to this type of data, because now we're starting to research, well, what happens if a country doesn't lock down as draconian as Italy or China has? What if they have more looser policies like we have here in the States? We have not had a very strong, unified approach to locking down our citizens. So what the research currently shows is that even if we extend this by an extra week, the economic impact of that is not just a single week. It tends to be significantly longer. So this is really the risk that we currently see, is that if we go an extra week because we don't social distance as much, and we have to extend our outlook or the slowdowns for significantly longer, that's actually what causes, I think, the largest economic impact to all of us. This extra additional week, because of lack of social distancing or not a strong social distancing, is the biggest risk. And I have some of the numbers to show you on that. And Jim makes a really good point. Sweden has not locked down their state. How are their stats? I actually looked at that in our Nordic webinar yesterday. The stats so far, because it's so early and their sample size is so small, I think yesterday they only had 22 deaths. It's really hard to extrapolate that into the type of data that we're looking for. But Sweden is one of the countries that I'm paying attention to for understanding, how that impacts. Because the thing about Sweden is the fact that, if they don't lock down, and they're able to contain the rates of coronavirus the same way we are, then they're better off, because by not locking it down, their economy is not as affected. So Sweden is an interesting case. However, I will say Sweden has a total of 8 million citizens. They're culturally very different than us, culturally very different from Spain and Italy. So it's sometimes difficult to draw conclusions from that to the rest of the world. But the reason that I want to show you this data and how sensitive the economic impact is to how long it takes for us to reach that peak comes from new GDP estimates coming out of Bank of America yesterday. Now, if you look at these numbers, they look pretty bad. And these are numbers that we've continuously seen revisions to the downside. Ever since I started doing these morning outlook webinars, we went from slightly positive to slightly negative to slightly more negative, and now we've gone from slightly negative to really negative. And so first of all, global GDP estimates was 0.3% for 2020. That's been knocked down to negative 2.7. That's a pretty big move. US GDP knocked down from 0.8% growth in 2020 down to negative 6% growth. Eurozone, negative 1.7 to negative 7.6. China from 1.5 down to 1.2. These are subject to change, again, even further. Perhaps to the upside as well. I do think that this was a pretty big move in terms of how they are coming up with these numbers. But if you look at the research, the impact isn't necessarily from the perspective of they think that this is worse than we had expected. This change in estimate purely comes from the length they expect a country to be knocked down, to be shut down for. And the trends currently that we're seeing, originally we had applied China as a template, but we clearly see that unless you lock down all of your citizens, prevent them from leaving their homes, prevent them from going outside, prevent them from traveling, on public transport, traveling on planes, the length of time it takes to reach that peak is longer than China. Italy is a good template, but even Italy actually has instituted fairly draconian measures to contain this. And not all countries like the US and Spain and many other developed countries have not instituted that. So each week that we push out the peak, the economic impact is actually significantly worse than we had expected. So that speaks to why these estimates have been knocked down so much in the last week since I've spoke to you on last Friday. Now, I think most people will ask then, if things are really that bleak, why hasn't the market sold off? And if the market hasn't sold off, isn't that a net positive? Because usually we say if bad news doesn't push the markets down, then that usually means that we are near a bottom. However, I will put a caveat on that, and that is the fact that we don't know that the peak is going to be pushed out an extra week or two. These are just assumptions that if the peak gets pushed out a couple of weeks because we don't practice the same level of social distancing and locking down our cities and states, that we can have this type of economic impact. It's just showing you how sensitive the economic impact is to just an extra week or two in reaching our peak. So this is not necessarily to say that this is where we're headed. This is more so to tell us just how sensitive the economic impact is to that peak. And unfortunately, when we're going to reach that peak is something that we can't really measure until perhaps a week after we've reached that peak, as you can see here in Italy. So what we're saying here is that Italy locked down on March 9th. It really took us till April 1st to really confirm that that was a peak. The thing is that you don't know you're at a peak until you've passed it. So there's a lot of time that it takes between the time you lock down to the time you can confirm that you're at a peak. And that's why, you know, this type of data, it's not something that we look at, oh, we think that economic impact is going to be really large. It's something, it's kind of like watching water boil. It's something that just takes time, and you're going to see it little by little every single day. And that's why I don't think you're just going to see, you know, these type of revisions and all of a sudden a market sells off. So many times people will say that, you know, if the markets don't sell off after such bad news, this is good news. I'm just saying, be a little cautious, understand the risks of what we're getting ourselves into, and keeping a track of the peak in number of deaths, because that will give us a much better understanding as the economic impact and just understanding how sensitive the data is. And lastly, what I wanted to talk about are just some of the themes that we currently see. So the market has had a pretty big segmentation between what we would consider stocks that have done okay versus stocks that have completely fallen off a cliff. So we want to talk about some of those themes, and I do want to also talk a little bit about something that, for those of you that did catch the webinar or the live stream that Michael and I did last Thursday, Michael Coe from CNBC, we talked a little bit about, you know, what our expectation is when things do get back to normal, or when we do open up restaurants and our economies again. And Michael had a pretty optimistic view in terms of how things will bounce back, because we've been stuck indoors for so long. I think the first thing we're going to want to do is go out to a restaurant, eat, and I think we're absolutely going to see that. I think the consensus is the fact that things will bounce back very, very quickly. But I will say that based on the employment data that we're currently seeing, based on the new estimates that we're seeing as far as when we'll see employment get back to normal, and that's being pushed out way into 2021, I think that you might get an initial bounce that may actually even overshoot the markets, especially on the consumer spending side, but will taper off quite a bit after that initial move. So we might see a bit of a V-shape, what looked like a V-shaped recovery initially, but what might end up looking more like a W-shaped recovery, because I think that after that initial surge of consumers wanting to get back and buying things that maybe they held off buying over the last couple of weeks, or last couple of months, whether it's a new computer or iPhone, or going out to your you know, your local restaurants to support them, I think that after that initial push, you might see a decline, because there are millions of people that are out of jobs, and they will struggle to get back into them, because, you know, the longer this goes on, the more likely you're going to see a shift to automation for some of those jobs, or people who have found other ways to fill those roles outside of having a person to do that. So those are some of the themes that we currently see going on in the market. So first off, I'll start with automobiles. This is really a sector that we think is going to be hit quite heavily. Not only the automobile sector, but also the suppliers for automobiles. Many of them may end up going out of business, which may be a really tough place for a lot of these major auto suppliers to be in. So, right now we're basically expecting that Q2 is going to be zero revenue for a lot of these automobile companies. And we see substantially subdued growth in 2020 and 2021. So the growth multiples for these companies are going to be knocked down significantly. I will say that there is a difference between GM and Ford versus Tesla, because GM and Ford do rely on other suppliers to make their cars, versus Tesla mostly relies on themselves to make most of their parts. I think Tesla makes like 85–90% of their parts on their own, versus GM and Ford is substantially lower. So they have far more risk in terms of some of their suppliers perhaps even going bankrupt during this time, and they may have trouble getting back on their feet. So that is one theme that we're currently seeing in the markets, and it's one to pay attention to. We currently have a short on GM that we put out. GM is clearly one of the decliners here in this particular market, down 5% yesterday when the markets were up about 2.25. Tesla, same thing, down about 5.6% yesterday when markets were up 2.25. So, this industry is certainly one that we think is going to struggle over the next couple of months. Hospital groups. This is one that actually I think is somewhat heartbreaking, because hospitals are the ones on the front line trying to battle this. They are the ones that are most affected, yet they are the ones that are going to lose almost 100% of their revenue, because normally they have elective surgery, they have everything else that's been pushed out as a result of coronavirus. And they're almost, if you look at most of these hospital groups, almost 100% of the beds right now are for coronavirus patients. And we don't believe that revenue from that, meaning I don't think they're going to get the same amount of revenue to make up for the offset of the lost revenue. We hear from these hospital groups slashing pay for their workers, which is absolutely heartbreaking for the medical doctors and nurses that are on the front lines doing this. So I do think that for those of you that are gainfully employed and are able to do this, I highly recommend you to consider looking at some of the local charities that you might have to support your local doctors and hospital groups. But this is a group that we actually think is going to struggle substantially or financially over the next couple of quarters. Packaged food. This is one of the, I would say, darlings of the market right now. So we've seen about 30 to 40% growth in food spend at these, specifically for these types of packaged foods. And this is partially because we've seen almost 100%, almost a 60% decline in restaurant spend. So that money people still have to eat. They're spending it on packaged foods. Hormel and Campbell's Soup, I think, are the clear winners in this particular group. Both of these have seen well into the 30 to 40% growth in their food distribution. And as you can see, if you look at Hormel, it's back near its February highs. So it's almost, it's had this very volatile V-shaped recovery. But, at this point, the longer this lasts, the more supported these particular stocks are. And we've seen growth in these stocks. So I expect that these stocks are actually going to do quite well from a revenue perspective and a profits perspective over the next few quarters. I will say the one caveat for a lot of these packaged food companies is that the cost of supplies and the cost of labor has gone up for them. So I do expect profit margins to be pushed down a little, but revenues have gone up 30 to 40%. And I think that's going to more than offset some of that. Same thing with Campbell's Soup. Very similar chart for Campbell's Soup. Initial, I would say, surge due to hype, if you will. That hype has died down, and I think this is an opportunity to potentially go long these particular names. I do think that if you're going to go long, for those of you that did catch our webinar yesterday on enhancing your equity positions, to consider selling puts as a strategy to get into some of these trades, because you can sell a put option here, a $45 put option, and collect $80, which is a 1.69% yield. That's almost a 2% discount on the stock purchase here. I would like to buy the stock at a 2% discount if possible. You can even get a little bit more aggressive and sell them at the money, maybe a 47 put. If you really want to get it, you'll get $1.50, which is a 3% discount. So these are, that would be how I would play trying to get into some of these packaged food names. Business continuity and security, as the longer we work from home, the more we are going to shift the way that we work from home, the more also security becomes an issue. We've seen lots of stories about work calls being interrupted as a result of hackers, and just a lot of different things that that is actually going to really shift the way we work going forward. I think a lot of companies may look at their business model after all of this and say, why do we need to buy so much office space when everyone seemed to operate fairly okay working from home? Maybe we can cut back on spend on office space. So there are huge ramifications for the current situation that we're in, and it may not benefit certain companies like WeWork, or perhaps some commercial real estate companies that provide office space to corporations, but will benefit some technology companies that allow us to do this, Zoom included. I will say Zoom is trading right now at some pretty crazy valuations, and I actually think Zoom is a pretty good, I would say you can almost use Zoom as an indicator of how crazy things are. When Zoom stock comes down, that's telling me that people are a little bit more settled. People, when Zoom stock is at 160, they're trading at 1,500 times earnings, which is a pretty hefty valuation, to say the least. I think I don't think it's a good investment per se. I think you can certainly trade this. We did earlier this year. But Zoom coming down to 121 tells me that the hype is coming down a little, or the fear is coming down a little. You can almost use it as a fear indicator, if you will. But I think if you think longer term, companies that really support working from home and working remotely and security, and also automation, companies like Salesforce, company like Oracle, as a result of this, certain jobs may be replaced by automation because they couldn't they couldn't be filled at the current time due to labor constraints. So stocks that facilitate automation, stocks that facilitate remote working, especially in the liquid names like Microsoft, Salesforce, Oracle. There are some smaller names like Slack. However, I do think that the liquidity on those are far worse, so I don't necessarily think that you should venture into some of those names at the moment. And the liquidity is also something that we think is worth looking at. And lastly, social media and streaming. We've been looking at the App Store downloads, and some of these have been extremely strong, but I will say be careful, because not all of these names, I think, fall under the same category. I think you have names like Disney, Grubhub, Peloton, and Netflix. These are names that may actually do well, that have seen strong App Store growth. I like the Disney play because they've seen pretty strong Disney Plus numbers. They're about to launch in Asia, but I will say Disney has a huge has another huge side of their business, which is the amusement parks, that's taken a huge hit. So I'm concerned that those two offset each other. So I'm not as bullish on Disney. Grubhub clearly is a winner at the moment because of the people that can't go out to restaurants are going to order food, and it's a good way to support your local restaurants so that they can hopefully stay in business during this time. Peloton, for those that like to work out at home, I have a Peloton standing right here. I've had it for quite a few years. It's one of the best things that I've ever purchased from a workout perspective. I think that stock that's going to do well. Netflix also a clear winner here. The ones that I would be staying away from or be cautious about are Facebook, Snap, and Twitter, because these are stocks that are very liquid, that have seen substantial growth in App Store downloads. However, these companies are supported by ads. They're not supported by you downloading them. So in this particular environment, ad spend is falling off of a cliff. Companies see that they're having an extended length of time where business is not going to get back to normal. A lot of the companies that are advertising on these platforms are going out of business and laying off their customers. So I don't see advertisement roaring back to life the same way that some of these companies may be, some of the estimates may be expecting to. So I'd be careful about venturing into some of those names. You know, the name that I think that I like the most out of all of these is perhaps Twitter, because I do think Twitter has done a good job of cleaning up their platform. But, you know, if we look at some of those charts, I think they may be starting to form a bit of a bottom here. So those are some of the names that I'm paying attention to, some of the themes that we're paying attention to, you know, going the next few days of trading. I will say that liquidity is something that you should still be very careful about. Liquidity actually worsened a little bit in the last couple of days. Let's take a look at where we stand right now in terms of liquidity. I think when I did this on Tuesday, we had about 130 liquid names. Right now, we're not too far off. We're at 95 names. So, you know, liquidity did drop off a little bit. I will say the very liquid name seems to stay roughly the same, about 50 names or so. So, and the list is now sorted based on most liquid to least liquid, so that you have a sense for liquidity. SPY obviously being the most liquid. I don't think that's a surprise to everyone. But this is, again, sorted based on liquidity. So if you're looking for names to trade, try to stick to the top of the list in this particular market, especially if things start to move fast again. So it looks like we're about to open up just about flat here. I know Europe predominantly has been down a little bit. Asia was down a little bit, but you know, the one I'm really keeping my eye out is on the VIX. If VIX gets below that 47 level, that's telling me we're perhaps in a bit more of a risk-on environment, and hopefully, you know, we see a bit of a bottom here in this particular market. So with that, you know, that covers what I wanted to show you guys here today. Again, I hope that this was useful for you guys to set up your day and your thinking as far as where the markets are headed. At this point, I'll try to answer a couple of questions that I have time for here. Brian's asking, I'm not convinced the market has bottomed. I completely agree. But like I said, even though the research clearly shows that there's a huge amount of risk to the downside in this particular slide, huge amounts of downside. I'm not, you know, we were originally knocking down GDP by, you know, 0.5%, 1%. Now we knocked it down by a full 6 percentage points. That is not where the market is currently trading. However, like I said, this is based on estimates that the peak will come a little later than some of the models currently show. And I don't think that's fully priced into the market. But like I said, that's not something that's going to be priced in the market instantly. That's going to be a slow burn. It's going to be like watching water boil as we watch this particular chart take its way up day by day, day by day. Slowly is that, I think, going to come in. So that's my thought there. You know, a lot of comments about Sweden. I completely agree. You know, there are some people concerned about round 2 of coronavirus. That's also been, you know, discussed in some of those economic models. You know, I will say the one thing that will negate all of this is if a cure or a vaccine comes into play, or if somehow the warm weather slows down the virus. Those are two potential positives that we see. Again, those are big ifs, but those are risks that to the downside model that we are keeping an eye out. Why is Tesla still up? I don't think Tesla is still up. It's down, you know, 5.5%, unless pre-market today it's up. I haven't looked pre-market today. Oh, it is up. Whoa, it's up 12%. Oh, interesting. After deliveries data, looks like now expects a Q1 profit. Interesting. So Tesla, different outlook than GM and Ford, perhaps. Let's see. Packaged food has grown in part due to millennials no longer able to get 100% fresh organic food. Sometimes, I'm not exactly sure as to all the reasons as to why. I'm certainly sure that that's part of it. But at the end of the day, packaged food is up by a large amount, not just by a little amount. We're seeing 30 to 40% growth in those categories. So that's why we're bullish on those particular stocks. A couple of comments about Zoom. I really don't know about that pending lawsuit. But again, I'm not trading Zoom right now. I think it's too volatile of a stock. So let's see. Looks like Tesla just opened up at 505 right now. Let's see where the market's opened up here. Looks like we're pretty much flat on the day. So again, happy trading, everyone. I hope that you guys have found this useful. We'll be sending out the recording to everyone here in about an hour or so. So thank you so much. I hope that you guys find this useful, and I will see you guys next Tuesday. Have a great day.